Today, Zebec is joined by Paul McCaffery, Managing Director of KBW's Investment Bank, and Wayne Johnson, an Executive Advisor to KBW. KBW is based in New York City and is one of the leading investment banks focused on financial services and fintech more specifically. KBW provides its clients solutions across the entire capital spectrum, from capital raises to M&A. Paul and Wayne, welcome to the Future of Money series. We're truly honored to have you both on the program. Would love to start with a little bit of background on your careers and KBW's leadership in the fintech and crypto advisory space.
Great. Thanks for having us. Really appreciate it. Excited to do this and glad to be joined by my colleague Wayne. But I've been at KBW for 21 years, approaching 22 this summer. And we were acquired by Stifel Financial 10 years ago. Stifel is a very big financial institution a lot of people haven't heard of. It's an $8 billion market cap company, has $500 billion of assets under management with the high net worth channel. So it's the sixth largest high net worth brokerage firm. And yet a lot of folks don't know who we are. Stifel acquired us 10 years ago, as I mentioned, and we were at that time really thought of as the bank that banks banks. If banks merge, it would either be us or another competitor that would typically do that. But as banks have gone, so has KBW. And that led us into insurance in the 90s when Citigroup and Travelers emerged. It led us into fintech, asset management, and all different areas of financial services. We basically had the foray into the crypto space specifically accidentally because of the banking channel. In 2017, one of our clients, Silvergate, it was a commercial bank in California at the time, and they had the idea of transitioning from a traditional commercial bank into a bank that only services the crypto community and specifically Bitcoin. So we got together with Alan Lane back then, and myself and a couple of my colleagues raised them over $100 million to build out the SEN network, Silvergate Exchange Network, which was one of the most important interactive payment networks within the crypto ecosystem, which has since shut, unfortunately. And we can go into details on that. But that was our original foray into crypto. And that led me down the rabbit hole. And I used to run equities for KBW, but I moved over full time into investment banking because I became passionate about fintech and specifically about digital assets and wanted to spend all of my time focused there. And there wasn't a lot in the equity space to do so. So it's more fun to be over the investment banking side, raising money and helping on the mergers and acquisitions of these companies.
My introduction is, if you can't beat them, join them. I worked for a competitor to KBW and Stifel, Raymond James, for over 13 years. And prior to that, Robinson Humphrey, which is was an investment, Atlanta. And during that time, that's over a 20-year or so period in equity research. So I covered fintech and payments. Any company that touched money electronically was fair game for me. And as investors may recall, Atlanta is a hub for that kind of functionality in the US. There's a 70% chance anytime someone uses a payment card, a traditional payment card, it touches an Atlanta-based company somewhere in the process. And it's the primary reason I moved to Atlanta. Among the notable topics during that time, I helped take PayPal public, coming right out of the internet bubble crash, which was fascinating and has some relevancy to what we're talking about today. In a follow-up to that, when I joined Raymond James, I helped take Zoom public, which was remittance and was eventually bought by PayPal as well. So some common links there. There has been a thread of my research has been assigned to blockchain and crypto early. And I can totally understand Paul's motivation to move over to the investment banking area because there was really no direct way to make an equity investment, the publicly traded stock, into crypto during that time. And this is kind of pre-2018. And for the last 5 years, I'd been working in private equity in the same space as a hunter-gatherer and M&A advisor. And more recently, pleased to be associated with KBW.
Fantastic. Well, both very impressive backgrounds, and I'm sure we'll add a lot to our discussion today. So we'd love to get into our first kind of topic area, which is M&A in Web3, a topic not really discussed in the industry until recently, yet one that's very close to what we do here at Zebec. The first question for today is, what are the primary motivations behind M&A roll-up strategies that you see in the cryptocurrency industry, and how do they differ from traditional M&A approaches?
I think what you are building is quite unique. You've identified a very specific niche. There's over 1,200 payroll providers that kind of fit your criteria. It's also an anomaly because a lot of these are mature businesses that are producing revenues, and you could acquire them for 1 to 2 times revenues. The problem in other areas of crypto, that's just not realistic to be able to acquire something for 1 to 2 times revenues at this point. A lot of the founders would rather burn their companies to the ground than sell for 1 to 2 times revenue. So you've identified a very interesting niche where you can roll up a space, put on revenues, get to profitability very quickly. But in most areas of crypto, the capital markets and M&A environment are structurally flawed. You typically need 4 things to have a healthy ecosystem. You need venture. That's there. There were 85 deals done in the last 2 weeks. Venture deals done in the last 2 weeks in crypto. That's up from about 25 on average every 2 weeks in the month in 2023. So it's healthy on that regards. But the problem is once you get past the seed in the early stage, maybe the A, we're kind of hitting a wall. And that's because the crypto space, specifically digital assets, doesn't have a healthy private equity or sponsors community. It's really nascent. And you've probably seen this, but a lot of the fintech companies are getting taken private by these large sponsors. I know there's rumors right now that Nuvei, for example, which is in the payment system, it's a publicly traded company, it's going to get taken private. And it's not by a strategic, it's by a private equity consortium. So you have sponsors traditionally in fintech. You usually have strategics that are possible acquirers. And the problem is because of the regulatory backdrop, the traditional financial services players are not very focused right now because they're scared. They're scared of their own regulators. They're scared of the SEC. They're scared of the bank. They're scared if they do an acquisition that the licenses won't carry over. So unfortunately, the strategics are few and far between. And then lastly, access to public markets. Well, it's very obvious. I think everybody in the industry knows Gensler is antagonistic. And his tactics are basically trying to ghost a lot of companies and hoping that if they don't respond, a lot of the companies will just go away. So as Wayne had mentioned before, there weren't a lot of, or many, if any, ways to play crypto in the pure equity markets several years ago. And now there are some, but most of them are minors. But there's a lot of companies that have been sitting there waiting in the wings to get uplisted, and it's just not happening. So I don't think it's a healthy M&A environment right now for the general crypto space because you're lacking some of those key ingredients. But I think fortunately, a lot of the CEOs and founders and companies are starting to realize strength in numbers. It's better to be part of a big organization that has multiple product offerings, get to scale faster, get to profitability faster. So there's more willingness to get together now than there was a year or 2 ago. And I think part of it is because there's a realization this isn't 2021 anymore. They're not going to get those valuations. But the problem is, unlike what you guys are able to do with your series of acquisitions at 1 to 2 times revenue, there's really no one willing to do that right now. So there's a lot of kind of a stalemate and a bid-ask spread.
With the crypto companies that you're working with, how do you help them assess and prioritize their acquisition targets given the diverse range of companies out there in the space?
It's really about what the pro forma company is going to do and how much faster will they get to scale and profitability. And kind of like what you're seeing, what you're doing is you're rolling up some businesses where you can buy them at 1 to 2 times. And then as you scale up, your company's going to be valued at more. And the other thing is by putting those smaller companies onto your platform, you're enabling them to grow organically faster, which is making them more valuable, which has a nice flywheel effect. I think in most of the spaces that we're focused on for M&A, it's not just rolling up within the same vertical, it's trying to expand. So for example, there's a lot of businesses in the custody space. The problem is custody is really a loss leader right now. People are essentially giving it away. So in order to have a profitable business, you need to have other ancillary products that you can bolt on to those types of businesses. So it's really finding those businesses that will get you to scale faster. It's also trying to figure out how to go international. Too many companies started in 2020, 2021 with a thought of the US is the largest financial system in the world. This is a great place to launch and there'll be enough of a TAM for me to capture. And 3 years later, we're sitting here with a terrible regulatory backdrop. And so we don't have the ability to really grow and to get to scale fast enough. So a lot of those companies are having to go international. The other element, as you know, is that there's an off-ramp and an on-ramp issue, right? And basically, I mentioned that I started in this space because of Silvergate. Well, unfortunately, Silvergate's gone. And so are most of the banks that had directly serviced the crypto space. And that's a real issue. Some of these companies can't even get operating accounts, let alone get FBO accounts to service their clients. So it really has created a stalemate situation. And a lot of the companies are forced to find alternative solutions, go international, or do what you're doing and focus on finding a crypto native solution like stablecoins.
Absolutely. I mean, funding sources is definitely an important topic here to cover, particularly in M&A for crypto. In one angle, crypto companies have alternate financing sources, right, through the form of a token, but at the same time, you do rely on traditional financing through equity and debt offerings. How do you see M&A in crypto typically financed in terms of these three sources?
Well, domestically, it's not the ICOs, right? It's not the tokens as much. Internationally, that's a better option or a clearer option. But to date, there is still a willingness from the venture capital, not the sponsors, not the private equity folks, right? Because they're not there, but there is a willingness from the VC and the early investors to fund bolt-on M&A if it's going to be accretive. And we are still seeing that is a catalyst to allow for a capital raise. In fact, a lot of times there have been a number of situations where CEOs and founders have approached me a year ago with a capital raise, and fast forward 3-4 quarters later, they're still doing that capital raise, but they're starting to realize that M&A is the better alternative. And in talking with their investors, they're finding that's the willingness is go out and find something inorganic as well to justify me putting more money in. Not really a healthy access to the debt markets at this point.
No, we've seen that ourselves. But I think the user acquisition story, the acquisition of real world assets is a huge driver as well of these roll-up strategies. It's been particularly beneficial for Zebec to get to its $1 billion in payroll processed within 2 years of the company's founding. So what would you say are kind of key trends and opportunities for M&A roll-up strategies in the crypto sector that maybe have not have been thought of or tried before?
Well, I don't think it's really anything different than there's a realization now from the founders and the early investors that they have to be more willing to partner up. If you go back, because I write a newsletter and I always write about M&A and venture deals that are over $10 million, and you go back a year and I would go for months without having any M&A transaction that even happened. You'd have partnership announcements, but you really didn't have M&A. It started to kick off a little bit last year. Ripple got involved. They bought some custody assets and others. And now this past summer, he kind of started to pick up. And now every 2 weeks when I write my newsletter, I usually have about 5 to 8 M&A situations that are actually happening. And so it's just a realization that some of these companies, their burn is real and they're not getting to profitability fast enough. So they have to be willing to partner up. And so it's as simple as that. It's just a realization that the bid-ask spread has to tighten. But unfortunately, a lot of these founders would rather burn their companies to the ground than sell for 1 to 2 times revenue, which is, I think that it's eventually maybe they'll realize take equity in a business that's growing nicely and you can get back to a good outcome. But I think it's just the bid-ask spread has to change.
Yeah, well, getting the deal closed is one half of the battle. The other half is, of course, a successful integration with a crypto company, right? Particularly if you're acquiring a non-crypto company, processes and culture can be very different.
Absolutely.
I want to bring us back to something you said earlier about the blockchain application and blockchain infrastructure and the backend for some of the consumer-facing products. I think you started saying that the shift is changing. And for us at Zebec, we're driven by actually delivering useful products that incorporate blockchain in everyday life, be it payroll, be it payments, be it cross-border remittances. So Wayne, the stage is yours and talk about the trends that you're seeing based on all of your experience in this field.
Well, thank you, Elena. So on the payment side, traditionally, particularly in developed countries, consumers have been trained to expect very fast processing times with any kind of payment card transaction. And most people don't think about the process and they shouldn't. A good service just works. And it's the conclusion of a consumer's purchase decision. Blockchain introduces in the original form was security, but not speed. And where we are today, and we've evolved since the original white paper on blockchain dramatically back in 2008, is we have much faster processing times. And there is the potential for greater consumer adoption at the retail point of sale, which we haven't seen in developed countries so far. And one of the reasons for that is the speed and convenience of the existing system works well enough most of the time is one reason. So it's not completely broken. The second reason is in order for a new solution to be introduced, there needs to be multiple parties. And what made Visa, MasterCard, Amex, and Discover so successful was the ability to interconnect to all these consumers and merchants at the same time, including the financial institutions that those cards were issued on. That's a very difficult model to duplicate and to fund, which is why in the US, we only have 4 networks. Enter the opportunity for a new payment solution that is potentially lower cost for the retailer to accept. And suddenly the retailer has a reason to want to accept something new. And that notion, if you will, that circumstance is present, but the consumer has to be incentivized to want to use it as well. So there's got to be a consumer wants to use it, a retailer has to want to accept it, and a processor has to want to enable it. And we're still evolving into that model on crypto, but it's starting to happen.
I think you touched on something important, which is B2B and companies serving enterprise level clients. Through that integration of Web3 features, we are reaching the consumers without necessarily consumers understanding or our clients understanding that some of the features in their payroll app, their budgeting and the day-to-day financial tasks app is powered by blockchain. And so that's probably is what lots of folks are looking for in our industry, like in others, is like, what's this holy grail or super app or the iPhone moment? So what would be knowing the pain points of the financial systems, the money flows, the players, the regulatory environment, where you see that moment of breakthrough, and what other companies other than us you've seen in the space?
So one of the major players, for sure, Circle, is instrumental in helping if I can use this term, the institutionalization of stablecoins as a medium of value exchange. I think that's very important. Tether, and we've talked about Bitcoin, or we haven't talked about Bitcoin, but that's another crypto instrument that can be processed in the Lightning Network, which is very fast, much faster than the traditional backbone of blockchain. So those are just 3. There's a number of others.
Yeah, I'll jump on there, Wayne. Stablecoins are the killer app so far. I mean, it's only 10% of the market cap of the crypto space, but it's 50% of the transaction volumes. Stablecoins, they're mostly in dollars right now, as you know. And you've heard Nick Carter from Castle Island say that it's somewhere between like 12th and 15th largest nations reserves of the US dollar at this point of treasuries. And that's how big they are. It really so far, I would say you don't have the ubiquitous acceptance and adoptions directly by the consumer, but the business to business, it's the international transfer of money and the settlement. That's really what we're seeing. So, I always wonder, I was like, why are Visa and MasterCard really embracing crypto if it's going to basically disrupt what they do? And I think behind the scenes, it's less about, what Wayne talked about before, because people still are going to want to use their cards to get the rewards points. People are going to want to use their cards because they're going to feel comfortable about chargebacks and other elements that aren't solved yet with the crypto industry, which I think will get solved. I think actually crypto can reduce fraud, because I don't know why everybody is comfortable putting their public keys on their checkbook and putting their public keys on a credit card that goes to every institution. So I think that's part of the reason why you have a lot of fraud that I think you get lessened from doing it through the crypto rails. But for now, I think that the stable coins is a very clean, neat solution alternative to the ACH, the SWIFT system, et cetera. So I think settlement And business to business is really the app early on that's going to work. And eventually, and I know you guys are doing it with because it's great that you have WageLink, right? Which is the payroll solution. But a lot of the problems are the on and the off ramps. So you need to have an on and an off ramp solution. You guys do that with the Zebec card, but that's very, very important because even with the remittance issue, it's nice if you're going to be able to reduce the cost for both sides. Once the money is transferred via crypto rails, can they use it? Right. And that's the other element, is making it so that once the transfer happens, it could be used and accessed and not subject to the government controls.
Anything else to add in your big picture analysis of the moment in the industry that we're living?
I think it's fair to say at this point that major payment players see that there is a place for crypto in payments in some way. And I think that's one of the reasons why you're seeing the brands working on some of these back-end solutions.
I think that you kind of need a network effect, right? In order to get things happening, I call it a big bang or something that's really going to create the reason for folks to adopt. Apple for years was trying to introduce Apple Pay, and a lot of folks ignored it in the States. And now all of a sudden the adoption, it just picks up and it picks up and it picks up. And then all of a sudden, boom, it's folks are using it. So I think that's going to happen with other areas in the crypto space, but they have the benefit of having, their phones in the hands of millions and millions of people. So I do agree with Wayne earlier, where I think the easier foray in is to start with business to business or B2B2C. Direct to consumer is pretty tricky. We've seen PayPal with their PayPal stablecoin dollar, their effort. They've got access to 300 million, I believe, globally consumers. And really the adoption is picking up, but it hasn't really become ubiquitous yet. And I think it's because they have to do all these different integrations with all of the retailers and all the providers. So they should have an advantage here. But I think it does show you that direct consumer is often quite hard to get unless you have those kind of wedge products to get off the ground. So it's easier to start with a B2B business model, which again, you guys have found a smart niche in the payroll space as a way to get to those consumers.
I think we're thinking along the same lines. We talked juxtaposing traditional rails or legacy systems versus crypto. Do you see, and you touched, Paul, a little bit on that already, do you see the integrations, the merger, the path as coexisting rather than a replacement?
We'll see if it's peaceful coexisting when people are getting disrupted. But, last week, Larry Fink, that was an unbelievable combination of TradFi and Web3, right? When BlackRock, they're integrating with Bank of New York, and then you have Securitize is doing the tokenization. So you're kind of marrying both sides. And after the first week, they launched with $100 million on it. They're already up to $200 million. A week later, and there's a real use case. And they are starting with B2B, right? It's $5 million is the minimum at first and eventually go to 100,000. There's going to be a lot more use cases. It's just basically a competitor to a money market fund. They just figured out how to tokenize it, which should make it easier for international and for domestic distributions between crypto players to start, and then eventually from everybody. So I do think that they could coexist, but you're going to need leaders like Larry Fink, behemoths, to really put their heft behind it and to push. We've seen other examples. Mike Cagney with Figure, and he was a co-founder of SoFi, went out to found Figure, and he found a niche within the real world asset space as well. And what he did is he went out with home equity loans. And why was he able to have success with home equity loans? Because it's pretty concentrated in terms of who are the biggest originators of those loans. So if you can tackle and go find those out of the gate, you can get scaled faster, because it really is important to basically make the product. Again, I keep using the word ubiquitous, but it's homogenized. You have to have standards so that there's volumes and secondary market activity to make that network effect work. So I do think that there can be an integration, but it's not going to be easy because a lot of folks are going to be disrupted by that.
This was excellent. Anything to add to this or closing thoughts?
No, I appreciate what you're doing, because I do agree with, having early wage access for money that you've already earned and having the rails and the capabilities of doing that. it's not as easy as people think with the old system, right? Because the problem is someone would always have to front the cash. It's a lending product. The issue is ACH and Swift and the traditional systems take days. And by the way, crypto doesn't have a bank holiday, right? People who are working over the weekend, they would have access to their wages immediately. And that couldn't happen on traditional rails. You have to push forward and do it on blockchain. And so I do think the direction of travel is going towards blockchain for payments and for settlement. Eventually, you're going to be able to have access to everything in a wallet, stocks and bonds and go international and transfer. But there's still a lot of frictions, and we have to fight the incumbents. And it's not going to be easy, particularly in the United States, because there's a lot of people getting paid for all of those latencies that exist in the incumbent system. If folks are listening, I would just urge, think about finding a partner. It really is important in this space to strengthen numbers, get to scale faster. There's not as healthy of a M&A and a capital markets infrastructure. So be smart about finding a partner before your burn becomes an issue.
Wayne, your closing remarks, if you have any?
This is really very early stages, even though it feels like it's been around a long time to me. And as Paul said, B2B is a great place to start, and there's a lot of running room there. So that by itself can help drive more awareness for businesses and eventually consumers. And hopefully, if we turn the page on a more cooperative regulatory environment in the US, we'll get more consumer usage out of some of these applications.
I agree with Wayne in terms of the regulatory backdrop. Having been one of the folks who helped build out the Silvergate Exchange Network with raising the capital from back in 2017, and then knowing that the bank regulators shut them down, they didn't fail. We had a bank who would have acquired them. We had capital to infuse into the bank. The regulators didn't want them to exist, so they shut them down. The same thing with the SEC. The SEC is not acting in good faith. A lot of what they're doing is trying to actually ignore a lot of these companies until they fail. They really are not giving access to capital markets. And, that's one of the three pillars of the SEC. So unfortunately, a lot of the folks, if you're going to focus on the US, you're going to have to challenge the regulators or go international.
This was awesome. And we look forward to having continued the dialogue.